Yeah, good morning. Sorry for the inconvenience because this is in Word file, and also our technical person says that is Word file is not open in that SteamYard. Therefore, I converted into. He suggested me to convert that PDF. PDF is also has not took. He came and he rectify the problem. Okay. Last class, I explain gave that problem that ABC Limited. Then income statement is also I explained that. Then position statement is also explained that. With the help of that, here we need to solve. We need to calculate the 17 ratio. That is also we explain that. Then before that, before to solve the problem or calculate the ratios, statements or income statement and position statements are most important. Income statement also last class I explained that. Here that is vertical statement, that is in sales 8,50,000 less cost of goods sold. Cost of goods sold is equal to opening stock plus purchases plus direct expenses minus closing stock is equal to cost of goods sold. This is most important. Then after that you will get that cost of goods sold. Sales minus cost of goods sold, we can get that gross profit. Gross profit less operating expenses, that is two operating expenses are there, that is 30,000 and 1,50,000. 1 lakh here gross profit minus operating expenses, we can get operating profit. Here is also operating profit less interest, that is 15,000 interest, we can get 1,45,000 profit after interest. Then after that less non-operating expenses 4,000, then 1,41,000, then add non-operating incomes 9,000. Net profit, PAT, profit after tax or before tax, that is PAT, we call it as an PAT or PBT or PAT, profit before tax or PAT, profit after tax. That is, it depends on the availability of the information, we can go for that. Here capital employed is equal to, capital employed means the capital formation in the form of equity and debt. Equity means real owners of the company. Last class also I had explained that equity and debt holders are, that is loans and advances. Interest, if the company make a profit or not, we should pay that, the company should pay that interest. But it is not so in case of equity shareholders and preference shareholders. If the company make a profit, then only they go for declaring dividend, that is capital employed. Then investment of capital employed, that is also assets, land and building and plant and machinery, total assets, we call it as an investment on capital employed. That is working capital, we know that, we already, those who are from commerce and management, we already studied that working capital is equal to current assets minus current liability is equal to working capital. What are all the current assets that is available provided in this problem, and what are all the current liability that is provided in the problem, that is working capital is equal to current assets minus current liability is equal to working capital. These informations, working capital is most important, current assets are most important, total of current assets is most important, total of current liabilities are most important, total fixed assets are most important. Then total debt is most important here. These are all the information we needed to calculate the ratios. Then equity, total equity is most important, net profit is most important, then profit after interest is most important, then operating profit is most important here, gross profit is most important here, then cost of goods sold are most important. If you calculate the ratios, these statements are, these minimum informations are most important. Okay, here 17 ratios we need to calculate that. That is first one, current assets minus current liability, that is current assets, what are all the current assets, we total already, we prepare in the form of statement, we already know total current assets is, see here, total current assets is, that is 2,50,000. Then total current liability is, that is 1,30,000. Current ratio is equal to current assets divided by current liability is equal to 2,50,000 divided by 1,30,000. Why we calculate total current assets are most important. Otherwise, if you again and again, if you go for totaling that current assets and totaling that current liability, that is time consuming, because you don't have time. Minimum 45 minutes you need to complete this problem in examination. Minimum 45 minutes, within 40 to 45 minutes. Therefore, these statements are most important. Current assets is 2,50,000, current liabilities 1,30,000. 2,50,000 divided by 1,30,000 is equal to 1.92 is to 1. Because here ratio means what do you mean by ratio? What do you understand by ratio? What is the significance of ratio? Ratio exists the relationship between two concepts or two numbers. Two concept, current assets concept and current liabilities concept. Exists the relationship. What is the relationship between current assets and current liability? It exhibits the relationship. That is the ratio. That is the beauty of the ratio. 2,50,000 divided by 1,30,000 is equal to 1.92 is to 1. It exists the here 1.92, it represents current assets, then 1 represents that is current liability. Yes, here standard is 2 is to 1. Standard ratio is 2 is to 1 because nearer to standard ratio, because 1.92 is, if you go for round off, that is 2. 2 is to 1 is some ratios are that is specified by AIS, ICWA and Chartered Accountant Tech, ICWA board and Chartered Accountant board. That is some ratios are standards are there. Majority of the ratios having its own standards. Organization has to maintain that standards. That is most important here. Then only because standards, if you follow the standard, then only we can make a profit. What are all the criteria or rules and regulations are there? That on the basis of that, they go for that. That is standards. Yes, standard is 2 is to 1. That is nearest to standard. What is the narration? Some problem they are asking for narration as explanation. Explanation. If you go for calculating the current ratio is equal to current asset divided by current liability, what 2,50,000 total current assets and total current liabilities 1,30,000. 2,50,000 divided by 1,30,000, 1.92 is to 1. The standard is 2 is to 1. If you write that some problem narration, you should exhibit the narration is also here. What is the narration explanation for this ratio? Though it is satisfactory, unfavorable for the organization as major portion of the assets, current assets, that is constituted in stock, constitutes stock in trade. Because satisfactory, the ratio is satisfactory. Why it is satisfactory? 1.92, 2. The standard is 2. 1.92 is there, nearer to the standard, therefore that is satisfactory. But the major portion of the stocks, current assets, that is constituted in stock in trade. See in the previous problem. What is the stock? See here. Oh. See the stock 1,49,000. Stock is 1,40,000 in current assets. See the current assets 1,49,000 current assets is there. Cash is 31,000 is there. Debtors is 71,000. That is stock is 1,49,000. That is not advisable. Stock should not be, because opening stock and closing, whatever may be, stock should not be preserved. If you more stock, if the organization have more stock, less sales. That is nothing but less sales. 1 minute. Hello. Yeah. Okay. That first ratio is over. The current ratio. Second one, quick ratio or acid test ratio. Quick ratio or acid test ratio is nothing but is equal to quick current assets or acid current assets or quick current liability. Quick current assets divided by quick current liability. What do you mean by that quick current liability or quick current assets? Yes, see here, I mentioned here, quick current assets is equal to current assets minus stock and prepaid expenses. This is most important. Current assets, quick current assets is equal to current assets minus stock and prepaid expenses. If you deduct current assets minus stock, deduct the stock and prepaid expenses, you will get quick current assets. Quick current assets are easily converted anytime, easily converted into cash. Current assets 1 year, within 1 year. Current assets is nothing but within 1 year you can easily convert it into cash current assets. Here within fraction of second, quick current assets you can anytime you can cash, liquid cash, convert it to liquid cash. That is the meaning of quick current assets. Here quick current assets is equal to stock, current assets minus stock and prepaid. If you deduct current assets, deduct stock and prepaid expenses, you will get quick current assets. Then quick current liabilities also. Quick current liabilities means within 1 year liability. 1 year usually, because accounting period liabilities. That is current liability. Current means period. 1 year, within 1 year. That is current. Quick current, anytime. Anytime he may ask liability, we need to pay that. Anytime he may demand. That is quick current. Here, quick current liability is also OD. Current liability minus overdraft and cash credit. If you deduct overdraft and cash credit, you get quick current liability. I hope you understand that. This is most important ratio. Quick ratio or acid test ratio or liquidity ratio. Three nomenclature we are using: quick ratio, acid test ratio, or liquidity ratio. Liquid means easily converted into cash, or liability. Anytime the creditors or outsider can ask, the organization has to pay that. That is the meaning of that. Here, that is quick current assets is, because current assets is 2,50,000. Previous problem, see the total current assets 2,50,000 minus 1,49,000. That is what is that year in this problem? We don't have that prepaid expenses. Only stock is there. Stock 2 lakh, current assets is 2,50,000 minus 1,49,000. That is stock is equal to 1,01,000. That is quick current assets. Then current liabilities or quick current liabilities also current liability minus OD, overdraft and cash credit. Here, what is that? Overdraft is there or cash credit is there? Overdraft is there. 30,000 overdraft. Here, 1,30,000 total current assets, current liability minus 30,000 is equal to 1 lakh. Therefore, here the 1 lakh quick current assets is equal to 1,01,000. Quick current liability is equal to 1 lakh. 1,01,000 divided by 1 lakh is equal to 1.01:1. Standard is 1:1. Yes, this is also standard. As per the standard, it is satisfactory. Satisfactory. The ratio is satisfactory. Yes, that is the meaning of that narration. Third one, debt equity ratio. Debt equity ratio is equal to debt divided by equity. Debt means loans and investments. Equity means either it may be preference shareholders. Equity shareholders. In this problem, you don't have that preference shareholders. Therefore, equity. Equity means shareholders. Equity shareholders. Here, the debt equity ratio is equal to debt divided by equity. Therefore, debt is 70,000. See the statement, income statement and position statement. We are calculate that. Therefore, why total is most important. If you go for again and again, if you go for that is computing the ratios, if you go for totaling, that is you can avoid that, because each and every ratio we need total of debt and total of equity. Therefore, that statement, income statement and position statements are most important here. Here, debt is 70,000. See the that is position statement. Debt is 70,000. Equity is 2,80,000. That is also equity. See that statement. We already total equity. We already calculate that. Yes, 70,000 divided by 2,80,000. That is 0.25:1. Actual ratio is 0.2:1. 0.25:1. Here, standard is 2:1. Standard is 2:1. Then the narration says that as the actual ratio is below the standard, it indicates that the long-term solvency of the concern quite satisfactory. Lower the ratio, stronger is the financial position of the organization. Because what is this meaning of this narration here? Explanation here: less debt. Why less debt? Organization should always maintain less debt. If the company or an organization make a profit or not, the company or an organization should pay the interest. Therefore, if it is less debt, that is most advisable. That is most important. Then shareholders, if you make a profit, then only you go for declaring the dividend. Therefore, in that context, these explanations are most important. That is, the actual ratio is below the standard. Yes, that is most important. The actual ratio should below the standard. It indicates that the long-term solvency, because it is very difficult to loans and advances, payment of loans and advances, any time or after the completion of the period, the organization or a company should pay that loans and advances. That's what long-term solvency is concerned. That is quite satisfactory here. Lower the ratio, stronger is the financial position. All the capital formation should be in the shareholders form, not on the debt form. Why? Because of if you have loans and advances, if the company make a profit or not, but the company should pay that interest. Therefore, in that context, this ratio is most important for each and every organization, debt equity ratio. Then fourth one, fixed assets ratio. Fixed assets ratio is equal to net fixed assets divided by capital employed. What do you mean by net? Why total of fixed assets? Net fixed assets is nothing but total of fixed assets divided by capital employed. Capital employed is equal to debt plus equity is equal to capital employed. These terminologies is most important here. Terminologies. Net fixed assets mean total fixed assets is nothing but net fixed assets. Then capital employed is equal to debt plus equity is equal to capital employed. Debt is 70,000, equity is 2,80,000. Yes, net fixed asset. Therefore, why? The statements are most important. Income statements are most important. Position statements are most important. Total of that debt and capital employed are required. Total, all the totals. Only totals are most important here. With the help of the totals, we need to proceed calculate the ratio. Therefore, totals are most important here. Net fixed assets 2,30,000. See the statements, position statement. Then 2,30,000 divided by capital employed. That is also see that here 3,50,000. 2,80,000 plus 70,000. 3 lakh, that is capital employed is equal to 3,50,000. Then 2,30,000. That is net fixed assets, total fixed assets divided by capital employed, debt plus equity 3,50,000. 2,30,000 divided by 3,50,000 is equal to 0.66 is to 1. The standard is the actual ratio. This is an actual ratio 0.66 is to 1. The standard is 0.67. 0.67. This is 0.66. What narration says? As the actual ratio is less than the standard, hence the financial position of the company is satisfactory. Because always it should be less than the ratio, not it should be 0.67. It should not exceed 0.67. It should be less than the 0.67. That is the standard. If it exceeds that, investment on capital employed on, because if you invested on assets and land and buildings and assets or more than 67%, working capitals are most important here. Without working capital, day-to-day activities is more. It is not possible to run the business organization. Day-to-day activities expenses are most important. Only 67% of the capital employed should be in the fixed asset. That is the meaning of that. I hope you understand this concept is also. Yes. Next one, fifth one, fixed assets to net worth ratio. Fixed assets to net worth ratio. Here is also, that is net fixed assets 2,30,000. Then net worth. Net worth is nothing but, what do you understand by that net worth? Net worth is nothing but equity. Equity shareholders plus reserves and profits and other things. Net worth. Net worth is nothing but, that is equity, 2,80,000. Equity is 2,80,000. See that is position statement. There that is total that net worth. Here net fixed assets 2,30,000. The net worth, that is 2,80,000. Equity, net worth is nothing but equity, 2,80,000. 2,30,000 divided by 2,80,000. 0.82 is to 1. Standard is 0.67. What is the narration says? 0.67 is the standard. Here 0.82 is there. The narration says, or the explanation says, the financial structure of the company is not sound as the major portion of the net worth is utilized for financing fixed assets. See the relationship. These are all the standards fixed by the ICW and Chart Accountant Board fixed the standards. Here 0 point, because fixed assets net worth, the amount of net worth equity, that is 0.82%, 82% that is invested on fixed assets. That is not advisable. That is always 0.67%, 67%. 0.67% means 67%. That should be less than that. Then only the financial position of the organization. If you invested on capital assets, building, land, then machinery, because working capital is most important, other activities expenses are most important here. Therefore standard is 0.67, here 0.82 is there. That is not satisfactory. Each and every ratios exhibit the relationship between the two aspects and the performance of the company, how the company performs. The next one, I hope you understand that. Next one, proprietary ratio. Proprietary ratio is equal to net worth divided by total assets, vice versa. Net worth, that is equity divided by total assets. Total assets means both current assets and current total assets. Fixed assets and current assets is equal to total assets. Fixed assets, previous one net fixed assets, total fixed assets, that one. Here net total assets means current assets plus fixed assets. Okay, I hope see that pro forma, that is not pro forma, that is statement, position statement. We already, total assets is also there. Here net worth is 2,80,000. Net worth is nothing but equity. Net worth is nothing but equity. 2,80,000. Total assets is 4,80,000. 2,80,000 divided by 4,80,000 is equal to 0.58 is to 1. The standard is 0.5 is to 1. Higher the ratio, better is the financial position. Higher the ratio, better is the financial position, because here is standard is 0.5, here 0.58 is there. Therefore higher the ratio, the narration says, the explanation says, higher the ratio, better is the financial position of the organization, because net worth, total assets, utilization of net worth is only, that is 0.5. If you using that total assets to net worth utilization, that is more, that is essential for all the organization. In that context, higher the ratio, better is the financial position of the organization. The next one, stock turnover ratio. Stock turnover ratio is nothing but, because I already explained that income statement. While explaining income statement, already explained that stock turnover ratio is equal to, we need that cost of goods sold divided by average stock. Cost of goods sold is equal to, see here, second line, cost of goods sold is equal to opening stock plus closing stock this is regarding average stock. I already explained that cost of goods sold is equal to opening stock plus purchases plus incidental or direct expenses minus closing stock is equal to cost of goods sold. This is most important. If you go for stock turnover ratio, calculate the stock turnover ratio. These fixed assets turnover, stock turnover ratio, cost of goods sold important. Many a time this is most important, cost of goods sold. Cost of goods sold is equal to opening stock plus purchases plus direct expenses of trading account minus opening stock is equal to cost of goods sold. Then average stock, cost of goods sold divided by average stock. Here average stock is equal to opening stock plus closing stock divided by 2, because that is also, we already explained that here. Yes, here cost of goods sold is 5,10,000. See that income statement, 5,10,000 cost of goods sold is equal to 5,10,000. Average stock is 1,24,250. 1,24,250. Average stock is equal to, see that opening stock is 99,500 opening stock. Closing stock is 1,49,000 divided by 2 is equal to, here 2,48,500 divided by 2 is equal to 1,24,250. 1,24,250, 5,10,000. See the income statement, there we have calculated cost of goods sold Then 5,10,000 divided by 1,24,250, 4.10 or 4 times in a year. 4.10, or if you round off that 4.10, 4 times in a year. Turnover, stock turnover 4 times a year. That is the meaning of that. Then the other form is also how to convert it into days. Here times, if you go for converting a times, this is the formula: cost of goods sold divided by average stock is equal to, you will get that how many times, that is stock turnover in that particular year. Then if you go for converting it into days, average formula is average stock divided by cost of goods sold into 365. 365 average stock. If you go for days, if you go, that is times, this is for days. If you convert it into days, average the formula is average stock divided by cost of goods sold into 365. Here cost of average stock we already computed, that is 1,24,250. that is cost of goods sold, that is 5,10,000 into 365 days. In a year we have 365 days. 365 days, that is approximately 90 days approximately. 1,24,250 divided by 5,10,000 into 365, you will get that 90 days, approximately 90 days. This is most important formula, stock turnover ratio formula. If you go for converting into times, that is cost of goods sold divided by average stock, or if you go for converting into days, reverse that. That's all. Average stock, that is denominator should be numerator, then cost of goods sold, that is numerator should be denominator, into 365. 1 year, 365 days is equal to, you will get that 90 days, approximately 90 days. This is also most important, that is ratios. The next one, standard. What standard says? See here, what standards? Standard is 8 times a year, 8 times. But in this problem, 4 times. Why? What is the reason? Yes, narration says that actual ratio 4 times in a year is less than the standard. Hence, it would suggest that more sales are not affected, overstocking and inefficient inventory management. It would also affect the liquidity position of the organization. Inefficiency in management, because first ratio itself, liquidity ratio or acid test ratio, explain that 1,49,000. Opening stock is 1,49,000. Stock is 1,49,000. See here, stock. There is that. Yeah, quick. Stock is 1,49,000. What it says? It says actual ratio 4 times is there, actual ratio, but is less than the standard. Yes, we can understand that. Hence, it would be suggest that more sales are not affected here, because actually is 8 times should be turnover. Here only 4 times, double times, because majority of the stock that is in stock in trade. If it is in stock in trade, no sales, no liquidity, no profit. That is the reason. Yes, this explanation. The next one, fixed assets turnover ratio. Fixed assets turnover ratio. The formula for fixed assets turnover ratio is equal to net sales. Turnover is nothing but sales. Net fixed assets turnover ratio. Turnover means is nothing but net sales. Okay, fixed assets turnover ratio is equal to net sales divided by fixed assets. Turnover is nothing but sales, net sales. Okay, net sales divided by net fixed assets. Net sales is, see that pro forma, vertical pro forma, a vertical statement, income statement. Here 8,50,000 net fixed assets. See the position statement, 2,30,000 8,50,000 divided by 2,30,000, 3.7 times. Here, fixed assets to sales. The relationship between the fixed assets, because capacity of the fixed assets is more. Here, the organization inefficiently they are utilizing the fixed assets. Capacity is 10,000. The organization only using less than the capacity. That is the meaning of that. Fixed assets exists the relationship between fixed assets and sales. Yes, here actual ratio is 3.7 times, but standard is 5 times. Minimum 5 times should be turnover. The low ratio indicate the inefficiency in the utilization of fixed assets. They are not utilizing properly. The capacity of the machinery fixed assets is 10,000 units, but the organization is unable to utilize that. They are producing utilize that 10,000 units, only 6,000. Example, I gave that example. That is the meaning of that. Therefore, see, each and every ratio exhibit the relationship between, it tells the organization efficiency of the organization, efficiency of the organizations. Okay. The next one, ninth one, total assets turnover ratio. Total assets turnover ratio is nothing but total assets. Previous one, fixed assets, is here total assets. Turnover means sales. Net sales divided by total assets. That is total assets, net sales is 8,50,000. Fixed total assets is 4,80,000. Then that is 8,50,000 divided by 4,80,000. 1.8 times. Actual ratio is 1.8 times, but standard is 2 times. Here is also they are not utilized. The actual ratio is nearer the standard. That conclusion is that the resources of the company have been utilized efficiently and effectively. They are not efficiently using the total assets, not utilizing the total assets effectively and efficiently. That is that exhibit that. Therefore, each and every ratio that is tells about the significance of the two aspects, two components of the organization. Yes, that is the next one. 10th one, that is these also net worth. Yes, owned capital turnover ratio. Owned capital is nothing but net worth equity. Net sales divided by net worth, 8,50,000 divided by 2,80,000. That is 3 times. Then normal ratio indicate the better utilization of owner's fund. Yes, that is the narration of this. The next ratio, interest coverage ratio, debt service ratio, or fixed coverage ratio. Yes, here interest coverage ratio, debt service ratio, or a fixed coverage ratio is equal to net profit before interest and tax. NBPT, net profit, NBPT, net profit before interest and tax divided by interest. Here, therefore, net profit before interest and tax, that is nothing but, what is that? Nothing but net profit before interest and tax. Yeah. What is that? That is operating profit. Net profit before interest and tax is nothing but operating profit. That is 1,60,000 divided by interest 15,000. 11 times. 1,60,000 divided by 15,000 is equal to 11. This is 11 times. What is the meaning of this 11? Organization can pay the interest 11 times of his profit. 11 times he can pay that. That is therefore why debt equity here 11 times organization can pay that. The company can pay that 11 times to the debt holder. If the company make a profit or not, the company should pay interest to the debt holders. Therefore, in that context, here what 11 times is there, higher the ratio indicate the regular and periodic payment of interest. That is the duration. Some ratio we don't have that standards. Some ratio we have that standards. Okay, next one, that is operating profit ratio. Operating profit ratio is equal to operating profit divided by net sales into 100. Then operating profit is, see that income statement, 1,60,000. The net sales is 8 lakh. See that income statement, 8,50,000 into 100 is equal to 18.82 or 19% approximately. Standard is 10%. Company is more profitable. Standard is 10%. 10% because here the profit is 18.82. The company is acceptable. 1 minute. Hello. Hello.
Hello, namaste, sir.
Namaste.
ಇದು disaster management open elective.
Now I am in class.
Okay, sir.
Okay.
Then,
After 15 minutes you can call me.
okay.
Yeah, here that is return operating profit, that is 1,60,000. Net sales is net sales into 100. 1,60,000 divided by 8,50,000 into 100, 18.82, approximately 19%. Standard is 10%. Company is more profitable. The next one, return on investment ratio. Net profit before interest and tax divided by capital employed into 100. 1 lakh operating profit 1,60,000. Net profit before interest and tax nothing but operating profit 1,60,000 divided by capital employed is, that is both debt and equity, 3,50,000 into 100, 45.7 or 46% approximately. Standard is 50%, 15%. Company is highly profitable. Company is highly profitable. Yes. The next one, return on total assets ratio. Net profit after tax divided by total assets into 100. Net profit after tax is 1,50,000. Total assets is 4,80,000 into 100. Here is equal to 31.25 or 31, approximately 31%. Here standard is 10 to 12%. Higher ratio indicate the, that is productivity of the resources utilization is also more, and also that is profitability. That is the meaning of that. The next one, these ratios are most important. Then next one, the 15th one, net profit ratio. Net profit divided by net sales into 100. Net profit is 1,50,000. Net sales is 8,50,000 into 100. 17.64 or 18% approximately. Higher net profit indicate the higher profitability of the concern. Then 16 gross profit ratio. Gross profit divided by net sales into 100. Gross profit is 3,40,000. See that that is profit. Gross profit is as provided in the problem itself. That is income statement and position statement. 3,40,000 divided by 8,50,000 into 100. 40%. Higher gross profit indicate the profitability of the concern is more. Then last one, earning per share. Last one is EPS, earning per share. Earning per share is equal to net profit available for equity shareholders divided by number of equity shares. Net profit available for equity shareholders means profit less interest less preference shareholders preference dividend. After that, that is available to EPS, earning per share, net profit available for equity shareholders divided by net number of equity shares. See that in problem, that is 1,50,000 is the net profit available for equity shareholders divided by 2,000 shares. Balance sheet. See that by 2,000 shares of rupees equal. That is 2,000 shares. Here 1,50,000 divided by 2,000 is equal to rupees 75 per share. That is the dividend declared by the company. I hope you understand this concept. This is ratio. This is most important one. Then another form, percentage, is the statement form, or that is vertical form. Then percentage, sometimes they gave the percentage of sales percentage, net gross profit percentage, net profit percentage, then capital employed percentage, and other things, fixed assets amount, like that. That is also, that kind of problems is also available in our study material. You should go through that. Yeah, tomorrow I will explain that. Go for that is fund flow statement, cash flow statement. If it is possible, that is marginal costing, we will touch as a next class. Sorry, next class I will explain that fund flow statement and cash flow statement. I will explain little bit explanation, 5 minutes explanation, and I will go for problems, fund flow statement and pro forma. I will explain the pro forma and I will go for problem, fund flow statement, and also cash flow statement. That is also little bit explanation, 5 minutes explanation, and I will explain the pro forma and I will go for solve the problems. If it is possible, today next class 12 to 1, I will complete fund flow statement and cash flow statement. Thank you. Yeah, thank you very much. Next class 12 to 1 class, we will join with us. Thank you very much.